Hey, what's up? Welcome back to video number 37. If you're not aware, I'm doing 365 consecutive videos, and this is number 37. If you get a value at any point, please hit the like and subscribe button. And without further ado, let's get into ticker symbol JPM. JP Morgan Chase is a worldwide financial services company founded all the way back. Their roots stretch to 1799. They operate in four segments: the consumer and community banking, corporate and investment bank, commercial banking, asset and wealth management. They have over $2 trillion in assets under management, $400 billion market cap. They are the biggest bank in the United States. Strong. They are everywhere. Everybody's heard of JP Morgan Chase. 6.8% annual earnings growth. Now, looking at the earnings and revenue, pretty solid, pretty steady. There was a dip in both of them post-pandemic. 24.3% profit margin. I love that. They're keeping $24.30 of every $100 that comes back to them. That is really healthy and strong profit margin for JP Morgan. Looking at the chart, they are at pre-pandemic highs where they close the week. Now, this is the weekly chart. Each candlestick represents a week. I got my lines down there checking out the 50-week moving average. JP Morgan is currently 32% over the 50-week moving average. So they're very high on the chart. I think they're going to come down a little bit. They are way above all the moving averages. Looking at the RSI, they are officially at 73, so they're oversold. And we're going to see what happens. Right now, everything has just been marching up, and I think they're going to have a pullback, and I would definitely try to pick them up closer to the $110, $105 range. Dividend is 2.65% yield, growing currently at 17% over the last 5 years. Very safe, solid dividend, as you see here, with only the payout being 47% of earnings. And I like to take it a step further. I like to know the payout ratio from the free cash flow. So I'll go to Yahoo Finance, open up the cash flow statement, and I will divide the dividends paid by the free cash flow. When I do that, I get 39%. So they are under 40% of the free cash is being paid out as a dividend, which means they have a lot of money left over to grow the company and do whatever they need to do. Not sure how much bigger they can get at $400 billion. And the interest coverage ratio, you'll see there is no ICR for banks, because banks, all they do is debt. That is how they make their money, by taking on and issuing debt. So they don't qualify for the interest coverage ratio. The PE is currently 17.78. Now, when you divide that into the 5-year average of 13.02, they are about 36 overvalued on this one metric. And this is a little hack. I'm laughing because you can see on Y charts, very fantastic company, a little bit pricey for me, very great service, but I can get the numbers I need looking through the gray here. You can just go to Google and type in JPM 5-year PE history, and you'll see Y charts is one of the top responses that comes up. Responses. It's not a response. It's a result, whatever it is. And yeah, so you can check it out here, and you can see you can get the numbers you need. You just need those two numbers, the current PE and the 5-year average. And the valuation, we look at Simply Wall Street, gives them $125.91. Yahoo, $134.51 analyst target. And Morningstar coming in at $112. Divide the three together, we get $124.14, making them about 9.5% overvalued from those three averaged together. And yeah, they're a bit overvalued. I say overvalued because as a dividend growth investor, I am always buying for passive income. I'm buying for that income stream. And JP Morgan, from what I can tell right now, is very solid, very safe dividend. Now, the banking sector makes me a little bit nervous. You know me, that I love the insurance side of the financial sector, and the banks worry me because of the regulations that could be coming down the pike, especially with the Democrats controlling the presidency, the House, and the Senate. So we're going to have to see how things play out with that. So for me, I'm holding. I'm going to give it a thumb sideways. I do like the company. I do hold them in my self-directed IRA, and I was buying them when they were around $95 to $100. So they're overvalued now, I think, by many different metrics. But if you want to jump in, by all means, I would not fault you. I think for myself personally, I may buy some shares of JP Morgan in the future if and when they come down, because as you remember, when they come down in price, that yield is going to rise. You're going to get more bang for your buck. So I'm waiting. I got a firm hold on JP Morgan. I'm not going to jump in, but when that price does start ticking down below 110, I'm going to be very, very interested. And let me know. Expertise comes from the community. In the comments below, let me know what you think. Oh, and speaking of the comments below, Digrin, Digrin.com is a new site I was alerted to by one of my subscribers, and I'm checking it out, and I like the aspect that I can share. It looks very solid. A lot of good free tools. The link in the description below. Click on it. You can see my Bridge account. I'm sharing the Bridge portfolio that I have been building, and check it out. Let me know what you think. I will be back. I will talk to you again in the next video tomorrow.